Over the last 10 years, I made 4 big mistakes with my emergency fund. I locked the money away and couldn't get to it when I actually needed it. I paid tax on interest I didn't expect. And one bank quietly dropped my interest rate to almost zero for 5 months and I didn't even notice. I'm an accountant, I understand tax, I understand savings, and I still got it wrong because nobody really teaches you this. So, in this video, I will walk you through the 4 mistakes I made and how I fix them so you don't make the same ones. Hi, I'm Cici, a chartered accountant with a background in finance. I break down the complex money rules so you can avoid costly mistakes and build long-term wealth. Let's get into it. Mistake number 1. I locked my emergency fund away, and it actually cost me money. It started with something that felt like a really good idea. At the beginning, I did what most people do. I kept my emergency fund in easy access savings accounts. Simple, flexible, safe. But then, I saw something tempting. Fixed term rates were about 2% higher, and I thought, why not earn a bit more? I had split my money into different buckets. One of them was my car fund, for maintenance or replacing the car. We'd just bought the car a few months earlier. Nothing's going to happen that soon, right? So I locked the money away for a year. I genuinely thought I was being smart. 5 months later, I crashed my car. The car was completely written off. We needed to replace it immediately, and we were short about £6,000. And that's when I realized my money was effectively out of reach. I couldn't wait till the fixed term to end, so I had to withdraw early. And here's the problem. Most fixed-term accounts will charge a significant penalty if you withdraw early, often around 90 days interest or more, and many don't allow partial withdrawal. So even though I only need part of the money, I had to close the entire account. I lost 3 months of interest in one day. I tried to earn a bit more interest and ended up losing even more. And honestly, I was lucky, because if that accident had happened earlier, the interest I'd earned might not have covered the penalty. I could have got back less than I originally put in. That's when it really hit me. Emergency money is not about maximizing return, it's about access. But at the same time, I still wanted my money to earn something, because realistically, things like a car fund or boiler fund, you might not touch it for a year or two. So I started looking for something in between, not locked, but also earn a bit more. And that's when I found accounts like bonus savers. The idea is simple. If you don't withdraw, you get a higher interest rate. If you do withdraw, you just lose the bonus for that month. No penalties, no lock-ins. So yes, if something goes wrong and you have to withdraw, that month you'll earn less interest. But even in that worst case scenario, your overall interest ends up roughly similar to a normal easy access account. So in a normal year, you earn more. In a bad year, you are no worse off than easy access. But you still have full access to your money. No penalties, no lock-ins, just flexibility when you need it and better returns when you don't. Personally, I'm currently using something like the HSBC Bonus Saver. I'm not saying this is the best account, but this type of structure works much better for this kind of money. Mistake number 2. I kept everything in one bank. It sounds simple, but if it happens, it is a complete disaster. For the first few years, I kept my entire emergency fund in one bank. One app, one login. Easy. It felt efficient. And then something happened to a friend of mine. Her account got frozen. Not hacked, not stolen, just frozen. It took 3 weeks and a pile of paperwork to get it back. For 3 weeks with no access to her own money. And that's when it hit me. If that had been my bank, I would have had nothing. No backup, no second account, no way to pay for anything. my emergency fund would have been completely useless at the exact moment I needed it most. So the fix is simple. Don't keep everything in one place. Spread your emergency fund across at least 2 different banks. So if one account has the access issue, you still have the access to the other. Because in real life, the biggest risk isn't just about losing money, it's about suddenly not being able to use it. Mistake number 3, I opened too many regular savers. At the time, it felt like I was doing everything right. Regular savers are genuinely brilliant. They offer some of the best rates in the UK, especially the ones that allow flexible withdrawals. Right now, for example, accounts from Nationwide or Loyals are offering around 6 to 7%. Because I was building part of my emergency fund month by month, for the kind of things you might need to dip into a few times a year, like home maintenance, this felt like a perfect solution. The only catch is the monthly limit. Most accounts only let you save £200 or £300 a month. So if you want to put away more than that, you need more than one. And that's exactly what I did. I opened 4, which at the time felt like a really smart move. 4 regular savers, 4 standing orders, I was very pleased with myself. What I didn't realize was how much maintenance they actually need, and this is where it started to go wrong. Because after 12 months, that high interest rate just disappears. Your money either gets moved to a low interest account or the rate just drops quietly to almost nothing. And to keep the good rate going, you have to open a new one yourself. Which sounds simple, but in real life, when you are busy, it's just one more thing that slips. And as a full-time working mom with basically zero spare mental bandwidth, I forgot about one of them for 5 months. 5 months of near zero interest on money I thought was working hard for me, and don't expect the bank to chase you. From their point of view, there is no urgency. So what I do now is simple. 2 regular savers maximum, enough to benefit from the high rate, but not so many that I lose track. And I set a calendar reminder the day I open it for 12 months later. Seriously, do it right now. Open your phone, set a reminder for when your regular savers matures. It takes 30 seconds, but it stops you from losing interest without realizing. And the rest of my fund, it sits in high-interest easy access account or a flexible cash ISA, which I will explain in the next mistake. Simple, no complicated rules, no annual panic. Just my money actually working for me. Because the best savings account isn't the one with the highest rate, it's the one you actually manage. And mistake number 4. This one still hurts. I ended up paying tax on my savings without even realizing it. As an accountant, I really should have seen this coming, but I fell for the most common tax trap in the UK. It cost me £170 that could have been easily avoided. Here is what happened. My total taxable income was sitting just under £50,270, the magic line that separates basic rate from higher rate taxpayers. As a basic rate taxpayer, you get a personal saving allowance of £1,000, which means the first £1,000 of interest earned each year is tax-free. I did some quick mental math, so I was earning less than £1,000 in interest, and thought, perfect, HMRC can't touch me. But I was wrong. When I sat down to do my tax return, I added all up properly, £925 in interest. Here's the catch. Interest is income. That £925 pushed my total income over the £50,270 limit. The second you cross that line, your tax-free allowance doesn't just shrink, it gets cut in half. Instantly, your personal savings allowance dropped from £1,000 to just £500. Suddenly, £425 of my interest was taxable at 40%. That was £170 handed straight to HMRC, money that could have paid for a family dinner or a weekend away. There are two simple ways to fix this. The first is a flexible cash ISA. Any interest earned inside an ISA is tax-free, but it must be flexible ISA. This lets you take money out and put it back within the same tax year without affecting your £20,000 allowance, which is exactly what you need for an emergency fund. Not all ISAs allow this, so always check the small print. If you want a full breakdown of how ISAs work, I made a full ISA guide explaining exactly how to use them. I will link it in the description below. The second option is pension contributions. If you're close to a tax band threshold, like I was, putting a bit extra into your pension can make a huge difference. Because it lowers your taxable income, which can pull you back into the lower tax band, and that means you keep your higher personal savings allowance. This is incredibly easy to do if you have a SIP, a self-invested personal pension, as you can usually just top it up via an app in minutes. One more thing, and listen closely if you're a high earner, because this is the most expensive mistake on the list. If your income is between £100,000 and £125,140, your tax rate isn't 40%, it's effectively 60%. And most people don't realize this. Here is why. For every £2 you earn in that range, you lose £1 of your tax-free personal allowance. So, if you earn an extra £1,000, your allowance drops by £500, which means more of your income that used to be tax-free is now being taxed. Here is a simple example. Imagine you earn £100,000 and you make an extra £1,000 in savings interest. That extra £1,000 is taxed at 40%, so you immediately lose £400. But that's not the full story, because earning that extra £1,000 also reduces your personal allowance by £500. And that £500 is now taxable at 40%, which is another £200 in tax. So in total, you paid £600 tax on £1,000 of interest. That's a 60% tax rate. And that's why even a small amount of savings interest on top of your income can cost you a serious amount of money. At that level, using ISA or increasing pension contributions isn't optional, it's essential. So, these are the 4 lessons I learned. 1. Flexibility beats a high rate. If you can't access it, it's not an emergency fund. 2. Spread across banks, because money you can't reach is money you can't use. 3. Keep it simple. The best account is the one you actually manage. 4. Interest is income. Know your tax band before you assume you're fine. None of this felt like a mistake at the time. That's exactly why that's so easy to miss. If this helped, give the video a like. It helps me reach more people in the UK, and subscribe so you don't miss the next video. Thanks for watching, and I will see you in the next one.